Can your investments have a positive impact on the world? At Standard Chartered, we believe money can be a force for good. Through your sustainable investments with us, we're financing hospitals that are the heartbeat of local communities, funding clean energy to make electricity more accessible, and investing in innovative solutions to clean polluted marine habitats. Sustainable investments that benefit you and parts of the world that need it most. We're Standard Chartered, and we're here for good.
Welcome everyone, and good day to all of you around the globe attending this virtual conference. I'm delighted, my name is Mark Fredefont, and I'm delighted to be moderating this panel on ESG structured finance, why and how the innovative securitization techniques will move the ESG needle. As you know, this panel discussion is taking place in a broader context of a global credit markets conference organized by and sponsored by Standard Chartered Bank, which has started 2 days ago and which will continue today for this afternoon. So if you have not already done so, please do register for the upcoming other panels. Before we jump up into the core of the topics, let me make a couple of housekeeping announcements. Number one, we would like as much as possible to have a two-way exchange with the audience. And so please do make use of the virtual chat room and ask your questions there. We will do our utmost to answer the questions and tackle them as we go. Number two, as this conference is open for the general public, let me remind our distinguished panelists to refrain from sharing private and confidential information. With these two out of the way, let us turn to the topics at hand and focus our attention on what ABS and CLO technologies can bring to the sustainable finance and ESG agenda. As we will see, innovative and bespoke securitization structures enabling impact investing require a lot of expertise and out-of-the-box thinking. So what does it take to ride this wave, and who will be the movers and shakers of tomorrow? I don't want to add unnecessary acronyms to a very crowded space already, but just in case, because you will hear a lot of these two acronyms, CLOs and ABS. Just to be sure, CLO stands for collateralized loan obligations, and ABS stands for asset-backed securities, both of which are well-established standards to finance portfolios of homogeneous assets. Let me turn now to the panelists, and a warm welcome to all my fellow panelists and distinguished experts here in Singapore and with us in the virtual chat room. So we are delighted to have with us today Dr. Stephanie Below, Chief Client and Investment Solution Officer at Responsibility based in Zurich. From Hong Kong, Mike Chen, Senior Vice President for Infrastructure and Securitization at HKMC, the Hong Kong Mortgage Corporation. And with me in the newsroom in Singapore, we have Robert Craybill, Managing Director and Chief Investment Officer at IIX, based in Singapore, and Walid Amar as well in Singapore, Senior Financial Officer at the IFC, International Finance Corporation, Treasury Client Solution, also based in Singapore. Let us straight jump into the first topic. As an issuer, why would you want to issue ESG or impact structured credit notes or CLOs? And as an investor, what are the reasons you may want to consider these investments? Stephanie, I'd like to turn to you first for the issuer's perspective, please.
Yes, sure. So Responsibility is a sustainable investment house specializing on impact investing, and we are focusing our investment in some of the most pressing issues of our time. So that's including climate change, of course, but also financial inclusion and sustainable food. So our goal has always been and is and has been for the last 20 years to actually bring more investors to impact investing. And we wanted to offer scalable and easy to invest solutions to investors and especially also to institutional investors globally. So we issued in 19, we issued a CLO of 175 million in size and brought with that financial inclusion in growth markets to the institutional market globally. And I think there are several reasons why we wanted to do that. I already alluded to one of the most important ones. We really wanted to use a format that is easily accessible and where professional investors basically can access a note, buy a bond via their usual bank counterparties. And obviously, this is also transferable security, an ISIN number, and that's the easiest way to actually buy a product. At the same time, we also wanted to really offer different risk-return characteristics to investors, because some of the institutional investors might want to have a different profile than the underlying assets. And just one more word on the underlying assets. Since we built a track record over the last 20 years, almost 20 years, we felt also the financial inclusion asset side, the underlying asset, are actually ripe for investment and ripe to offer to institutional investors, because compared to senior loans in the US and the European market, these assets offer a comparable yield when it comes, which is more stable. But at the same time, we have been building a track record in terms of loss rates that are lower than the usual senior secured loans that have been securitized in the past. So I think this kind of transaction, the standardization of issuing simply a note that cracks open an entirely different market for impact investment.
Yeah, thank you for this, Stephanie. Your CLO in 2019, as you mentioned, was a resounding success, and thank you for opening the road. I'd like to turn to Robert Craybill as well. Robert, I'd like to get your take on this as well, because I know we've been working on your series WLB, so I'd like you to give us your perspective on this as well.
Thank you, Mark. So at Impact Investment Exchange, we are also an organization focused on impact investment. For the last 12 years, we've been working in those markets primarily in Asia and to some extent Africa. And similar to what Stephanie described, a few years back, we saw the opportunity to offer a product that could appeal to a broad base of institutional investors. Our typical counterparties before that had been very specialized impact investors, and we wanted to use the CLO product and technology to really create an asset that could take loans to not only financial institution, financial inclusion players like microfinance institutions, but also to organizations working in sustainable agriculture and clean energy, and offer those in a way that could be have acceptable return and other characteristics for institutional investors. Our Women's Livelihood Bond product is a blended finance product, so we are also able to offer certain investment opportunities to government agencies or other investors who are willing to take more risk, and then tailor certain parts of the main bond, the Women's Livelihood Bond, that appeals to institutional investors with a lower risk but still very high impact product.
Thank you. Mike, turning to you from the HKMC perspective and as a issuer and potential issuer as well, would like to have your take on this topic.
Thank you, Mark. Just a few sentences about ourselves, just to put our response in context. The HKMC is a Hong Kong government-owned commercial entities, pivotal in a number of areas in Hong Kong, including the housing, retirement planning, and also local debt market developments. So our division says the focus is on infrastructure, senior debt, loan assets. So we started off around 2 years ago to book senior debt securities in infrastructure space, and longer term, we have the objective of issuing CRO or issuing securitization instrument on the back of these infrastructure loans. So our motive looking at ESG assets are a couple-fold. From the perspective of an investor, first, ESG investing is a trend. Particularly, we look at renewable energies, which nowadays actually offer a very attractive risk and return profile and makes a lot of economic sense. And, from a risk perspective as well, we have to be mindful about the ESG evolution over time as well, and from a risk perspective. And also as a government-owned enterprise in Hong Kong, we also, have a strong commitment to hold up to our corporate value. So that's why we look at infrastructure assets. Now, from the perspective of a prospective issuer, we do actually are mindful about the evolution now in the ESG standard in the world. And it's constantly changing and progressing very fast as well. And we would actually have to be very mindful about the trend in the market, our preference of the preference of our investor, etc., so that ensure that when we launch, it will be something that could be catered for the prospective investors in our CLO as well. So back to you, Mark.
Yeah, thank you. You're absolutely right to mention that this is really a fast-paced, a fast-changing world in terms of regulation, in terms of trends. And I'm sure we'll come back to some of the points Robert was mentioning as well, the blended finance influence. Walid, as an investor, because I know and you invested, IFC invested quite a lot into ESG CLOs and ESG structured finance. What is your perspective on this? Why would you considering doing this?
Thank you, Mark. So from IFC, the role is mainly developing capital market and emerging market. So securitization is one of the tools to provide more liquidity to the capital market. And also it offers different risk return to the investors, so it widens the investor base. And the other angle is more, it transforms illiquid asset to a more tradable asset, like loans, green loan. You can package them in more tradable security. So the angle is more developing those capital markets. So we invest either, we have two ways usually how we support this, either as anchor investor, where we anchor the transaction, which help placing this transaction in the market. And this is similar to what we do in plain vanilla bonds. So we do the same for securitization. Or provide credit enhancement in a form of a partial credit guarantee, which provide also to credit enhance the rating and make it easier to place in the market. So those are the two main roles that we play in the investing in securitization or ESG securitization. And also we have another angle which is more upstream, where we work and try to identify gaps in the market, and this is we try to solve and improve. So market like where we have a securitization framework, but you don't see many transactions happening like Philippines or Thailand. So this is also another angle where we try to support this product, actually.
Thanks, Walid. Let me check quickly the chat room. So just a quick reminder, please post your question. We would like to have this as engaging as possible with the audience. So do post the questions, and we would do our utmost to answer them. A lot of strong themes already for the first 10-15 minutes. Switching gears maybe slightly. For asset managers, investing in sustainable instruments is definitely or becomes a very clear investment decisions, and most of them want to get ahead of the trend for their clients. So getting a little bit more technical, maybe into the nitty-gritty of the technicalities of the topic, what are the typical challenges that you would face when dealing with these structured credit ESG impact instruments? What are the typical ESG metrics that you would monitor as an issuer and as an investor to track for these issuances? And what are the typical structural features that you have seen in the market? And I'd like to turn to Stephanie first, maybe. Stephanie, do you think the market is there in terms of metrics which are available for investors, for issuers to follow? And what do you think we should aim for, really?
In terms of impact investing metrics, there's by now more and more standards available, and we definitely map each of our investments to an impact strategy that is linked to SDGs. So I think another important point is not just to have measured numbers for these impact strategies, but actually also really engage and manage with the portfolio companies for specific outcomes. So I think there it becomes definitely more technical. It's a matter of measuring it, but also engaging with those. I have a really strong echo, unfortunately. But yeah, it's getting better now. So let me give you an example out of the CLO. So there we have obviously the target of improving livelihoods, but also employment generation for people. We have, for example, invested in a leasing company in one of the most polluted cities in the world, and they have they are managing to finance cleaner vehicles with their drivers. So obviously, one of them is improving the livelihood of those drivers, and these drivers taking a loan. But just as important point that you also can measure is actually the reduction in CO2 emissions that we are able to achieve by these investments, because each old vehicle that gets off the road, so replaced by the new one, has at least 20% CO2 emission reductions. So there you can see we also work with very specific examples there and go much deeper on the individual level. I also wanted to mention on some of the upcoming transactions that we're working on, for example, where we not just engage in employment generation for livelihood, but really also access to basic services. And there the example is just so timely. So that's why I really want to mention it. We are looking to offer basic services to people. So that means also healthcare and sanitation. So in healthcare, we are looking to, it's literally a hospital waiting to get financing from us in Vietnam. And this is so timely because obviously there is an emerging variant coming in Vietnam which really needs urgent attention. So that's just one or two examples to show you how you really make sure that your investment has an impact tracked directly to SDGs, but really also underlyings are very specifically managed by us.
Thank you. Thanks, Stephanie. And thank you for sharing these very important anecdotes on your investments. Mike, turning to you on the challenges and structural features that you would see as an upcoming sort of securitization issuer, what is your take on these structural features and the challenges to put that together?
Yeah, I think, one main challenge is up to date, the scope of ESG is still very broad. And which part of ESG are you going to focus? Environmental, social, or governance? Or, and also there's still a lack of consensus on basic definitions of some of the ESG issues. And there are still, while it's encouraging to see some convergent views on some of the issues, like now these days nobody really financed coal-fired power generation, but back in those days when I first started, we financed coal-fired power stations, around the world. Now, issues like energy transition and net zero, how do we arrive? There's really no really. The review still remains very diverse for people to take. So that's actually one challenge we constantly have to face. And the other thing is the ESG issue. How does it come into play with credit risk? So Project Finance 101 will ask you to bank on proven technology. But then, these days you will have to start to take a more forward-looking view on where the future technology will head to, and things like that. So there is a constant dilemma in terms of, either investing or structuring something for the broader investors. Go back to you.
Yeah, thank you, Mike, for these insights as well. Robert, I mean, we've been sort of, we had the pleasure to be your companion for the Women Livelihood Bond, and I'm sure you faced a number of challenges and structural issues. We would like really to have your take on this as well, please.
Yeah, thanks, Mark. So as you know, of course, there's many challenges. I'll say one of the key ones is really trying to balance risk, return, and impact. And with the Women's Livelihood Bond series, with each of the bonds, what we're aiming for is really deep impact and actually additionality, so that the investors can take have certainty that their money is going to fund and really make a difference, funding projects that might not otherwise be funded. And yet we also know, to satisfy institutional investors, while they want impact, they also need to see a risk and return that's appropriate, and that's how we use the blended finance elements to make sure that we're able to deliver that proper return for the risk. Since we're offering and kind of promising deep impact, we also focus a lot on impact reporting and measurement. And because we're doing a CLO, we're quite transparent. We tell investors up front where their money is going to go, what loans we're going to make with those funds. And for each entity that we're lending money to, we perform an impact assessment up front. And so we're really able to forecast the outcomes that we expect to see created by the funds that we're providing. And then we report against those outcomes over the course of the 4 years, tying that to the SDGs, of course, also performing SROI calculations so people can understand how much impact is being created for every dollar they're investing.
Thank you, Robert, for these additional points and reactions. And indeed, I mean, I remember quite vividly working on your issuance, and the disclosure requirements there were quite, well thought out, and so I remember that was there were a lot of debates around this, and I'm sure a lot of challenges as well. Walid, I'd like to turn to you on maybe the structural features that ESG green tranches may pose to investors. We've seen the advancements of certain CLOs which were not necessarily 100% sort of ESG as it pertains to their assets, but which have issued or which are issuing green tranches. I'd like to have your take on this as an investor. What is your take on this? And you have an ESG tranche which for CLO which otherwise may not be 100% ESG.
Yeah. So the challenge with securitization is you need to have a diversified portfolio, and this is why you see issuer trying to get this diversification by adding non-ESG asset in the portfolio, and this is mainly related to the structure of a CLO. So when we look to the transaction, obviously the whole portfolio need to meet the requirement from IFC point of view. So it's not only the ESG part, but the non-ESG part, and this is something that requires due diligence. Also, second challenge with securitization is you are one step further, especially in cash securitization, where the asset originated by a bank transferred to another SPV. So the level of due diligence is a little bit required to go a little bit further to understand this. So when we look to the ESG tranche is use of proceed approach. So we follow what the market is using, but we still have some relation to the the other tranche that we don't invest, which may not be ESG, just to make sure that still the whole structure still fit within eligibility, broader eligibility in terms of sector from IFC side. Yeah.
Understood. Thank you for this. So essentially, use of proceeds, like in any green bonds, when banks or other issuers, like banks issue green bonds, then we would have a use of proceeds, sort of a green tag on it. And with that, that means that the issuer would need to essentially invest into green assets, green loans in particular, a topic that we will come back to when we discuss the bank regulatory capital market. Just a quick reminder that please do not hesitate to engage with the panelists, asking questions on the chat room, make use of this possibility, and we will endeavor to tackle them as we go along. The next topic which I'd like to tackle with the panelists, I think it's of crucial importance for the success of a transaction, is of course the active engagement process. And I'd like to ask the panelists what their views are in terms of investor engagement process. I mean, some of these transactions, as we already heard, attract blended finance. Blended finance in the sense, you have private money coming in as well as public money. Public money can be a sovereign or an SOE entity coming in, or can be a multilateral development institutions like IFC, or can be another development institutions. And sometimes blended finance has also the connotation of having catalytic subsidies, making the transaction happen, without which this would not happen. So maybe I'd like to hear your thoughts on the blended finance topic, and if useful, what is the ideal timing to bring a multilateral development bank and a DFI and the private sector. I'd like to turn to Walid first, given your affiliation with the IFC, a multilateral development institution, of course. So I'd like to hear your thoughts on the blended finance and investors' engagement process.
Yeah, so from IFC side, maybe I'll clarify a little bit the blended finance angle. So from IFC side, we have IFC own account, and we can use other funds that we manage from donor, and this is what we call blended finance when we talk about. So from the role of IFC in general, when we interact in those transactions, given the type of structuring required, it's better to be early into the discussion to make sure that the structure meet all the requirement and economically feasible. So the advice is to engage early with the multilateral, and especially on those aspects. After that, it's more the economical side. So IFC own account, so we work with on a market basis. And if it requires some donor funding, this is where we can also try to see how we can improve the economic of the transaction to be marketable. Yeah.
Thank you. Thanks for this, Walid. So as expected, you expect arrangers to come to you early for you to be treated as an anchor investor to sort of enable the transaction. Yeah. And we've been working with you on several occasions with that framework. I'd like to turn to Stephanie, because I know, Stephanie, I believe you managed to carefully avoid and resist the temptation of blended finance. So it would be interesting really to have your views on this, please.
Yes, sure. I mean, yes, of course, we engage with the public entities, public money very early onwards, because yes, the process is quite a lengthy one in terms of meeting very specific requirements, but also defining exactly the outcomes that we want to target. So yes, we also engage with them very early on. Depending on the structure, obviously also it can actually be different than what is usually expected. It's not always just at the bottom as a risk cushion, but actually we also saw it the other way around. Our CLO, for example, was actually the senior tranche was financed by DFC. So I actually wanted to also allude that, yes, we engage very early on, but we also want to engage with institutional investors early on. And we see more and more who are very interested in doing that in the process, because they also want to build out an interesting impact investing portfolio. And as it turns out, it's important to match the two of them and have kind of an intercolloquial communication between because some of them have different risk-return requirements, and that's why they preferred to go into the equity bit in the CLO, for example. And some of them would like to have different features, which might be actually counter to some of the features that the DFIs would like to have in the CLO. So that needs to be balanced, and it's actually an interaction that works best for us. Because otherwise, if you bring in institutional investors too late, they might have last-minute requirements change to invest, and you simply will not be able to come out with a transaction if you lined up 30 different borrowers to actually receive financing right way, sooner way. And that's why I think it's really an interaction that is needed. And needless to say, for that, you also need really structuring expertise and working very closely with the investment bank on this together.
So essentially no particular time advantage given to blended finance or to multilats when you try to arrange a new structure, Stephanie, is that correct?
We are really trying hard to involve also the institutional investors early, so it stays an easy format. It stays an easy to invest format for institutional investors, and doesn't get too convoluted in some of the governance that is needed for specific requirements out of the FC world. But yes, we're trying hard.
Thanks, great. Robert, I'd like to turn to you now. IIX have been sort of using blended finance for your WLB Women Livelihood Bond series. So what is your take on this? And where do you see the engagement of the sort of public money versus private money? What's the timing and the engagement process?
Right. Thanks, Mark. Yeah. So we've been very fortunate to be supported by to have the benefit of a portfolio loan guarantee, a partial portfolio loan guarantee from the USAID Development Credit Authority for all three of the bonds so far in our Women's Livelihood Bond series, and for the upcoming WLB4 climate bond that we're working on. And that's provided, while it's a guarantee that we pay for, it's clearly provided at subsidized costs. We've also had used blended finance to provide a first loss layer of credit protection that also helps to protect institutional investors. It's typically also been provided either by DFIs or by philanthropic sources on concessional rates. And that allows us to deliver what I talked about before, that kind of very deep impact that's going out to enterprises that are not necessarily able to access funding from other investors. So, and that's that additionality that I mentioned. So we're very consciously trying not to lend to organizations that could access funds easily from the IFC, for instance, or from other DFIs. And so when we're lending to microfinance institutions, we're looking obviously for the ones that offer the most impact and impactful engagement with women entrepreneurs. But we're also looking to lend to those at, say, the lower tier 2 or tier 3, rather than the very large tier 1 institutions that have ready access to capital. And we're also very conscious to look beyond what investors may have become comfortable with in microfinance over time. We're looking to open up the markets into SME lenders, into ag lenders, and sustainable agriculture businesses. So we really take, we feel that we need to use, if we're getting concessional funding from DFIs, we need to use that to really go beyond what we could do without that. Now,
if I hear correctly, this is really pure additionality that you try to bring in when you bring in a DFI in the picture.
That's right. We're really looking, and we hope to see that money allows us to do what we couldn't otherwise do. I will say on the point, we find that DFIs are fantastic. They do take time. We like to engage them first up front, get them on board early, both just from a staging standpoint, but also to Walid's point that having them on board is a critical confidence builder with the institutional investors that we talk to.
I think it's okay to have some controversial controversy around this point. I mean, DFIs, you know, they have certain metrics to meet, and so therefore they would be typically slightly longer than others. Maybe Walid, you can comment on that.
Yeah, good question. So we have a lot of requirement to meet. So in terms of due diligence, so obviously this also make the time process slightly longer. But on capital market deal, actually we can process very quickly transactions. So it all depends on the complexity and the type of due diligence that required to be done.
Thank you. Mike, I wanted to turn to you now because you are affiliated to HKMC, which is an entity which is in the Hong Kong Special Administrative Region, so an SOE. And what are your views and on the topics of catalytic equity or catalytic subsidies to make a transaction happen? You mentioned to us that you are looking to do a securitization on infrastructure.
Yeah.
How do you see the sort of economics working? Typically, in our experience, the equity is have returns which may not be necessarily commercial or commercially viable. So I'd like to prod you on this, if I may.
Yeah, I tend to actually take a slightly different view at this. Probably, given our role, we're willing to take a longer term view. So in terms of that return and stuff like that, and particularly, in the context of infra CLO, this is a new, very, very new asset class. We have very limited precedents, but the attractiveness of the infrastructure loan assets probably has not been really fully appreciated by institutional investors. So say, if investors are, CRO investors are used to benchmarking these CROs to US CROs, which is, with the underlying collaterals being, leverage finance and things like that. Credit quality and the nature of the credit are quite different. Now, we do see that there is a potential to actually cultivate this market, and so that institutional investor can view this as a more standalone alternative asset class. And so from that perspective, I don't think, we are really subsidizing return as such. I don't know whether that's actually addressed your question, Mark.
Yes, it does. Thank you very much. And I think what you just said is essentially, the equity returns have to be commercially viable for us to sponsor a transaction or to originate a transaction. I think, Stephanie, you raised your hand, so please go ahead.
Yes, I also wanted to point out that we don't believe that these are subsidized, that we need to subsidize a transaction in order to bring it to market to institutional investors, because actually the underlying assets, and as I alluded to in the beginning, we have a long track record in managing these assets. And yes, it requires much more work in terms of the institutional investors getting familiar with the asset class, because it's new and it's an emerging market. But actually the risk-return characteristics are similar, if not better, to classical US and European corporate loans. So I want to make that point once more. It is also a question of educating the market about these new assets, new type of assets. And I think there, again, comes actually DFI to help as well, because there can change the risk perception to the market if they are anchoring a transaction.
Fascinating point. I mean, the fact that essentially not only you do ESG investing, but also you get a substantial or a good return on these investments. We finally have got some questions coming through. I think there was a sort of we couldn't get them before. One question anonymously asked, would like to hear your take on carbon trading with the rise of private capital markets. I believe there was a couple of years ago, and I'm going to turn to Walid. There was a forest bond which was issued, sponsored by IFC. If you would like to comment on that.
Yeah, yes, we worked on this forest bond. I didn't work personally on that transaction, so I don't know the details if you are looking for details, but the idea is the coupon on the bond will be paid either in cash or in credit, and the carbon credit is generated from underlying project related to the project. So this was the idea behind that structure, which we worked on a few years ago. Yeah.
Yes, I remember this was a really landmark transaction, bond, $150 million, which was effectively backed by voluntary carbon credits in the context of mangroves in Indonesia and sea carbon captures. We had a panel yesterday on carbon credit markets and the development of the carbon credit markets. Of course, there is, in the context of Singapore, CIX, which has been launched by SCB, Temasek, DBS, and SGX, which is there really to develop the carbon market trading, but the voluntary carbon market trading. So maybe one other question before we move on to the next topic. What is the size of the deep impact CLO market, both in terms of number and size of deals, and what is the growth outlook for the next 1-2 years? Maybe turning to Rob on this.
Well, thanks. I mean, Mark, you may have better data, but when we look out at the field, frankly, I'd be hard-pressed to find much beyond what we at IX and what Stephanie at Responsibility have been doing. There aren't that many other standards yet, although we think the market should develop and grow, and we hope to see more people involved.
Thank you. Stephanie, what is the market for the deep impact CLO?
I guess that is one of the main challenges, really, that yes, we can bring one transaction, but in order to get some kind of a standardization, you need to establish a program. And yes, we were planning to do every year a transaction like that, but COVID didn't quite allow it last year. But definitely we will be doing more, and hopefully we can then also show the market that this is a scalable business.
Thank you. Thank you. Talking about COVID, we have a question here. Do you think COVID-19 has made impact investing harder and hit the same companies hard globally? Maybe you, Robert?
I'll be happy to take that, because we did issue 2 bonds last year, one at the very beginning of the year in January, and we dispersed loans just before the COVID crisis. But then we actually went ahead and with Mark's help, managed to issue a WLB3 at the end of 2020, which we put together despite the COVID crisis throughout that. And I guess we've been pleased. Of course, we were caught unawares by the COVID crisis, but we've been actually very pleased at how the loans that we made right before the crisis have performed. I think part of our thesis is that if you're lending to companies that have very strong ESG characteristics, that are really working to address the real needs of the communities they work in, that in some ways they're actually better positioned to withstand shocks, and I think we've seen that throughout the COVID crisis. They're also, I'm generalizing here, but by and large kind of disconnected from global supply chains, and that helps them withstand these types of shocks. So we've been very, very pleased with the performance of the portfolio. And I think we were able to get the WLB3 done despite the COVID crisis, in part because we'd just prior to that really implemented a remote mobile-based impact assessment technology that we've been using. So a hallmark of our impact assessment up until then was that we would interview, and we still do interview, a very broad cross-section of the women beneficiaries of the organizations we're lending to. And obviously that physical interaction was something we couldn't engage in during COVID, but we actually had, as I said, just launched a digital tool to allow us to collect that data digitally and it allowed us actually to go out to many more women than we could have physically interviewed in the past. So that allowed us to move forward, and we're, as I said, we're moving forward now with WLB4 climate despite the COVID crisis.
Thank you. Thanks, Robert. There's another question which actually links quite nicely into the next topic we wanted to address. The question is, investors look for a pool which is well diversified, but does a focus on ESG will lead to reduce diversification and increase risks? So I'd like to link that up to the next topic we wanted to address, which was the ESG significant risk transfer market and banks' regulatory capital transactions on ESG. So how do we, as banks, reconcile the sort of green bond paradigm that I was alluding to earlier with the ESG SRT or significant risk transfer transaction market? The conundrum we have is that each green loans that we put on the balance sheet would be sort of pulled in 3 to 4 different directions. There would be the green bond that we issue, use of proceeds. We need to invest into these green loans. We have some urge to do ESG, CLO on SRT and regulatory capital transactions. So how do we reconcile all this? And I know Walid has been a very significant investor and arranger of these structures, and I'd like you to give your views to the audience.
Yeah. So on SRT transaction, actually, yeah, this is a great tool for capital management, and we did few transactions on that space. The challenge with cash securitization is to have enough asset that the bank is willing to sell, so to an SPV, and the challenge is having banks willing to sell the ESG-related asset, and this is the biggest challenge facing those cash securitization. With synthetic, the assets stay on the balance sheet, so there is an advantage from that point, so they don't need to sell and sell those assets. So you can structure those synthetic securitization and you can structure those without selling those assets, and you help with the capital, and you can link them to ESG. So this is one advantage of those synthetic securitization.
Yeah, thanks, Walid. Unfortunately, time is up. We have a couple of minutes. Maybe if any one of you wants to leave us with a last thought before I wrap up. Any one of you, Robert, or yes?
Well, I'll say one thing, which is I do think that what's going to grow this market over time is not any particular new innovation, but just us doing it again and again. I think we've seen that with each of the women's livelihood bonds, while I won't say any of them have been easy, each one has become easier to sell to institutional investors. And I think it's sort of a virtuous circle. As we do more, as responsibility does more, we'll see more investors become comfortable, and that will just help us to grow the market and scale the market, and hopefully a virtual cycle that comes out of that.
Stephanie, maybe one last word? Or Mike?
Thank you, Robert. I think that's really exactly the point, the most important point. Just adding a couple of features. I mean, to really make it more attractive to institutional investors, we need to work on some features that are still not perfect. Like, can we actually assign a rating? So we need to work with rating agencies. Or could we actually have a warehouse with regard to actually then having a broader diversified pool? So I think we really need to work on every one of the issuance to make it better, to make it more accessible to institutional markets.
Thank you. Thanks for this. So let me wrap up now and warmly thank all our panelists here in the studio and in Zurich, Stephanie and Mike in Hong Kong. Thank you very much for a very engaging and interesting discussion with a lot of strong themes and ideas. So we've seen securitization techniques have the potential to move the ESG needle because of these transactions are backed by large portfolios of multi-million dollars loans, and therefore there is an inherent operational leverage in ESG ABS in general. So given the wall of money currently being raised in the ESG space, we have observed a lot of interest in ESG structured finance space and start to observe the so-called greenium in that space. And these structured finance investments lend themselves particularly well to innovative features where specific ESG metrics are followed carefully and start to be biting on issuers and originators alike. So with this, I'd like to conclude this session and introduce the next virtual panel, which will start in 15 minutes now, which is navigating the headwinds, reasons to stay confident in the Asia high yield credit market. So stay with us and goodbye for now.